Investing in stocks can seem overwhelming, especially for beginners. But with the right knowledge and approach, it's one of the most effective ways to build long-term wealth. In 2025, the stock market presents a world of opportunity, but how do you get started if you're new to investing? This complete beginner's guide to investing in stocks will walk you through the essential steps to help you confidently dive into the stock market, with a focus on understanding key concepts and setting yourself up for success. In this video, we'll explore 10 stock investment strategies that can help you grow your portfolio and navigate the stock market effectively. But before starting the video, be sure to smash the like button and subscribe so you never miss out on our upcoming videos. Step 1. Set clear investment goals. Before you begin investing, it's crucial to define your investment goals. Why are you investing in the first place? Are you looking to grow your wealth over time for retirement, or are you seeking short-term gains? Your investment goals will help determine your strategy and guide your decisions moving forward. For beginners, long-term goals are often the best approach. This means you're looking to hold your investments for several years, benefiting from compound growth. However, if you're interested in short-term investing or trying to achieve specific financial goals, such as buying a home in the next few years, your strategy may differ. Knowing what you want to achieve with your investments is the first step in shaping your stock market journey. Step 2. Determine how much you can afford to invest. Investing in stocks requires capital, but it's important to know how much you can afford to invest without affecting your day-to-day expenses or emergency savings. A general rule of thumb is to only invest money that you don't need in the short term. Start small and gradually increase your investment as you become more comfortable with the market. As a beginner, it's a good idea to focus on building a solid financial foundation. Ensure you have an emergency fund set aside, typically 3 to 6 months of living expenses, and that you're not taking on more risk than you're comfortable with. The stock market can fluctuate, and it's important not to invest money you might need in the near future. Step 3. Understand your risk tolerance and investing style. Every investor has a different level of comfort with risk. Some investors are willing to take on higher risks for the chance of higher returns, while others prefer a more conservative approach. As a beginner, understanding your risk tolerance is essential to determining how much risk you're willing to take on in the stock market. Your risk tolerance depends on various factors, such as your age, financial goals, time horizon, and personal comfort level. If you're young and investing for retirement decades away, you may be more comfortable with taking on greater risks. On the other hand, if you're investing for a near-term goal, such as buying a home, you may want to take a more conservative approach. Step 4. Choose an investment account. In order to buy and sell stocks, you'll need to open an investment account. There are different types of accounts, including brokerage accounts, retirement accounts, such as IRAs or 401ks, and custodial accounts if you're investing on behalf of a child. For beginners, opening a brokerage account is the most common route. Many brokerage firms offer low fees, user-friendly platforms, and educational resources to help you navigate the stock market. When selecting a brokerage, consider factors like commission fees, account types, investment options, and the tools they offer. Some well-known platforms for beginners include Robinhood, eStarTrade, Fidelity, and Charles Schwab. Compare your options to find the one that suits your needs and goals. Step 5. Fund your account. Once you've selected your investment account, it's time to fund it. This can typically be done through bank transfers, wire transfers, or even rolling over funds from another account, such as a retirement account. Depending on your brokerage, you may also have the option to link your account to set up automatic deposits. When starting, it's important not to rush. Invest an amount that feels comfortable, and consider setting up regular contributions to steadily grow your account. Consistent investing is one of the best ways to accumulate wealth over time. Step 6. Learn about stock types. Stocks can be classified into different categories, such as common stock and preferred stock. As a beginner, understanding the basics of these types of stocks is essential. Common stock. This is the most common type of stock. When you buy common stock, you become a partial owner of the company. Common stockholders typically have voting rights at shareholder meetings and may receive dividends, but dividends are not guaranteed. Preferred stock. Preferred stockholders have priority over common stockholders when it comes to dividends and claims on company assets in the event of liquidation. However, preferred stockholders generally don't have voting rights. Understanding the difference between common and preferred stock is important, as it helps you decide which type of stock aligns best with your investment goals and risk tolerance. Step 7. Diversify your portfolio. As a beginner, it's important not to put all of your money into one stock. Diversification involves spreading your investments across different stocks, industries, and even asset classes, such as bonds or real estate. This can help reduce risk and provide a more stable return over time. For instance, you might invest in technology stocks, healthcare stocks, and consumer goods stocks to ensure you're not overly reliant on any one sector. Additionally, diversification can also be achieved through mutual funds or exchange-traded funds, ETFs, which contain a mix of different stocks or assets in one investment. Step 8. Start investing in index funds or ETFs. If you're not sure where to begin, index funds and ETFs can be great choices for beginners. These funds pool money from multiple investors to buy a diverse set of stocks, typically following a specific market index like the S&P 500 or the NASDAQ. Investing in these funds allows you to invest in a broad range of stocks, offering instant diversification. Index funds and ETFs are often recommended for beginners because they require less research and selection compared to buying individual stocks. They also tend to have lower fees, making them cost-effective options for long-term investors. Step 9. Understand the basics of stock valuation. Stock valuation is the process of determining the worth of a company's stock. As a beginner, you don't need to become an expert in valuation, but understanding the basics can help you make more informed investment decisions. There are different methods for valuing stocks, such as the price-to-earnings, PE, ratio, price-to-book, PB ratio, and dividend yield. The PE ratio, for example, compares a company's stock price to its earnings per share and can provide insight into whether a stock is overvalued or undervalued. As a beginner, learning to evaluate stocks based on these basic metrics can help you make better investment choices. Step 10. Monitor your investments and stay informed. Once you've started investing, it's important to keep track of your investments and stay informed about market trends. The stock market is constantly changing, and understanding how economic news, interest rates, and global events affect stock prices can help you make informed decisions. While it's crucial to stay informed, it's also important not to overreact to short-term market fluctuations. Stock prices can rise and fall based on various factors, and a well-thought-out investment strategy should focus on long-term goals rather than daily market movements. Investing in stocks in 2025 offers tremendous potential for growth and wealth building, but it's important to approach it with a clear plan. As a beginner, setting clear goals, understanding risk tolerance, and learning the basics of stock valuation are essential steps in your investment journey. Diversifying your portfolio and starting with index funds or ETFs can provide a solid foundation while reducing risk. Thank you guys for watching. If you want more videos like this, make sure to like the video and hit subscribe button, and we'll see you in the next video.